we had in March. How would you read the markets now that those are behind? Most experts would argue nothing really came out of them positively.
Good morning and thanks for having me over. Yes, I think the most significant feature in a sense of March was the local lack of liquidity. In fact, this has been an issue since the time I started work in 1985, and this is like 26 years that every March, for one reason or the other, whether it's advance tax payments, whether it's local funders closing their books, or it's just institutions wanting for year-end to reduce exposures, one reason or the other, or the most recent reason, which is the insurance companies wanting to actually book profits for dividend distribution, etc. Each of these reasons keeps our markets very much on a tight leash in March, and March usually is a very difficult month for local institutions and local mutual funds, HNIs to navigate through. So if you, the rest of the issues, I think, whether it's the budget or it's the elections, in a sense, only ended up weakening the perception of the ruling party. So as we stand today into April, I think a couple of takeaways. I think the Congress government needs to do a lot more now that it's firmly and squarely with its back to the wall. Needs to do a lot more to actually show that it's not a government with almost a near majority and yet doing nothing. And I think that perception needs to change. State elections have proved that much of the populism that they've been looking at or other factors they've been trying to attribute to win elections have not really come through. So really speaking, they have nothing but basic development agenda to pursue, and I think that's really what even the state elections are throwing up, that basic development agenda that needs to happen. So coming to that, I think there are that's the good news, that there is no expectation from this government. Nobody expects them to do anything. Every single policy measure in a sense gets rolled back, or in a sense gets held at the last stage before getting passed. So as we stand right now, the expectations are low. So whatever they do and they can manage to get that passed would actually be seen as reasonably positive, because in the international backdrop we've got problems resurfacing in Europe, the jobs data in the US giving us jitters about the pace of recovery there being not as strong. China, people fearing may have if not a soft but definitely a landing which is likely to be a little uncomfortable. So given all this, I think India still, we're talking about 7% growth, and I think if a few measures, like for instance May 5th, I understand there's a meeting to determine with the state governments whether FDI and retail is something that can be even contemplated. GST is another item on the agenda. But the most interesting thing is a small takeaway from the Goa state elections, where post that, the Chief Minister actually slashed VAT in order to reduce petrol prices. And that might well be the way going forward, that if, in a sense, demand is not getting destroyed with higher petrol prices, why not go the other way, which is to actually start dropping taxes, import duties, etc., with a view to A, reducing subsidies, and B, reducing the impact on inflation. And that, I think, may well be the way going forward. So one innovative, if you will, solution may well be the dropping of duties, which while in the medium run will have a revenue issue, but if there is no slackening of demand, then obviously collections will or could actually make up, or larger collections could make up for lower duties. So that's one, I think, which could be keeping inflation in check.
I just want to take on a bit about the liquidity bit that you talked of. I'm glad you started with that because, even here on this channel, Jakes, we've been for the last 2 or 3 months, in fact, we're calling it the liquidity crisis. You have a situation even today where a 3-month paper, you're borrowing at almost 12-13% as a corporate. Well, how severe is that still? I know you talked about March and the factors that March brings with it, but do you think that that concern from a corporate India point of view remains, and it's a serious concern?
Well, not really as alarming as it's been made out to be, because March tends to accentuate this problem, because the entire introduction of liquidity through the CRR went away in advance tax collection. So come April 10th, 15th, which is the week we are sitting in, should be the period when the liquidity actually starts coming back, and already people are talking about liquidity having eased slightly. Slightly, I say, because the money is now coming back as state governments start actually spending money and other other expenditures sort of take off. So the liquidity will ease as we move into the credit policy on April 17th. And I believe that the long bond trading close to 8.7 is a matter of some concern. I do believe that 9 is an absolute no-no. So a cut, whether a further cut in CRR or an interest rate cut will for sure come through, especially if done hand in hand with a duty cut on crude and on petrol, etc. So really speaking, I think if that were done hand in hand, you could have inflation in a sense being kept in check. Food inflation still remains a problem, but liquidity will improve. And I think as project spending starts, you will have the pickup which people have been waiting for in terms of investment activity. And I think that is the second thing, where power reforms and some movement in the power space is already beginning to be felt. Iron ore and coal continue to be a problem, but that's something that the government needs to address. But somewhere along the line, I get the feeling when they are pushed with the back to the wall, a few of these measures will start rolling out. And not the least of the reasons being this entire, the only reason crude and gold, etc. are still up in international markets, up more than our comfort zone, is because of this liquidity sloshing around and the perception of a QE3 coming. Were a QE3 not to come or be moderated in some form, I think, with this level of economic gloom worldwide, there's no way that crude can be in the 120s as far as Brent is concerned. And I expect a sharp correction in crude as being the last bastion of commodity prices to fall. And that needs to happen, or that will happen. It's completely outside our control. But I do believe some regulatory check, because from the US government or Europe, could happen in terms of CFTC contracts, etc., which is being talked about but never acted on.
So you mentioned, Jakes, that there is almost zero expectations as far as the market is concerned from the government. So would you then therefore say that the next trigger could be actually April 17th on what happens coming out of Mint Street?
I think the biggest expectation is of no expectation. And therefore, I feel one or two wild, out-of-the-box ideas that the government can contemplate. I'm just leaving one on the table. I mean, this is, for whatever it's worth, an idea that's been debated with a couple of people in our space, if you will. The concept of divestment bonds. The government today is borrowing close to 8.5–9%, at about 8.5–9%. And one of the ideas that we had was, if you can float divestment paper with equity warrants linked to it, that means the government divestment program gets done with an NCD warrant kind of structure, where the NCD is at 5%, and linked to it are, let's say, warrants of ONGC, BHEL, etc., which the government wants to divest over a period of time. And the individual or the institution gets the right, to convert these warrants into equity at today's price anytime over the next 5 years. So at one stroke, you've pegged it to today's prices. 5-year window, which is an optionality, which is much more than the 3–4% that they lose. And I think you could be talking about raising a few lakh crores through this process. The government needs to open its mind and open its window to a few out-of-the-box ideas which take it back to divestment, because the more the lack of participation or the reduction in participation in the public sector, the better will be the bang for the buck as far as the private sector participation in the investment cycle is concerned. Today the problem is the government seems to be crowding out the private sector, both in the equity markets and in the public and in the debt markets. And I think the borrowing costs are keeping most private sector participants from being able to borrow even freely. So my sense was that were you to have a divestment bond kind of thing, which actually, I don't know which forum it is that one needs to raise this, but effectively a divestment bond is nothing but an NCD which the government borrows at and pays back your money after 5 years, or converts that same money into stock that it owns in PSU corporations and gives it back to you at today's market price over the next 5 years. Frankly, nobody gives a damn as to what price the government divests its holdings in the PSUs at. Most of these are historically held and close to par. So the 30,000, 40,000 crore divestment target could actually get exceeded several times over. And we need more steps as a second step, like the gold import thing, which actually kills unproductive imports. And if you look at our trade balance, net of gold as a constituent, I think you're talking about a pretty healthy picture. So a slightly weaker rupee than we had in the past, maybe a rupee in the 50-52 range,